Hello, welcome to the Mutual Fund Show. My name is Niraj Shah, and over the next 20-25 minutes, we'll talk about a particular facet of mutual funds. And frankly, this time around, we're trying to talk about what should you as an investor do if you get a feeling somehow that the equity markets are near levels which might be unsustainable for whatever reason. They may actually move up further from these levels, or they may go down as well. But if you believe, and that's what investing is about, right? That you have a hypothesis, you follow that hypothesis. Sometimes it turns out to be right, sometimes it may not. But if presumably that is the hypothesis that the markets may come off, what should you as a mutual fund investor do with your existing funds as well as new fund investments? And of course, to talk about that in greater detail, we've got Raghav Iyengar. He's Chief Business Officer of Axis AMC. He's joining us for the first time on the show. So welcome, Raghav. And we've also good afternoon. And we also have Kshitiz Mahajan. He's co-founder of Complete Circle Consultants. He joins us on the show as well. Kshitiz, great having you back.
Good afternoon, Niraj.
Yeah. So, well, Raghav, can I start with you?
Yes.
I wonder if these are the queries. If we were in a normal world wherein you guys would be going out and talking to people in various cities doing these events, maybe a lot of people will be asking you, "Kam abhi paisa kyun dale? Kyunki market to itna upar hai." And frankly, it is hot. So, what's your sense, Raghav? I mean, how would you guys believe that it is time to judiciously approach the quantum of equity investing that a person does to mutual funds?
It's a lovely question, and it always gets asked at every high point of the market, whenever the market was at 5,000, 10,000, 20,000, and now, of course, it's crossed the half a lakh mark, which is 50,000. My view in this is that, we did a small exercise, and I'll share that with you separately, Neeraj, so that you can tell your viewers about it, that if you pick the 10 best times to invest, which is the 10 days the market really fell, and you pick the 10 worst days, which is when the market really went up, and you compare that to just period of sustained investing, the guy who's invested in a sustained way actually has made the most return. So in this place, I think the key thing here is to be in the market at all points of time. Yes, of course, markets are at two levels. Investors are a little stressed about coming in. If they're not comfortable about coming directly into equity, maybe equity funds, maybe a slightly lower risk fund, maybe a hybrid fund might be an answer for that. And that's where you see over the last 2-3 months, if you see the data which comes out of AMFI, the hybrid category has actually shown some stupendous growth. So hybrids are in some sense proving to be a good option for especially first time investors if they want to come in and invest in the market at this time.
Sorry. Yeah. So Raghav, tell us a bit about hybrid funds. I mean, what are these funds, and why would you believe that investors who are looking at the markets at the current juncture make use of them?
So hybrids are in some sense, a fund which has a combination of various classes of assets, Neeraj. So a fund, let's say, the various investing classes that are available today are equity, fixed income, gold, now of course international equities, and of course you have REITs. So a combination of these is if the fund invests in a combination of these or a couple of these, they're essentially called hybrid funds. Now typically hybrid funds come from the fundamental principle of asset allocation, right? So asset allocation, if you manage to keep your assets, your investments in different buckets, and especially if those assets tend to move differently, your overall investment experience will be far better. That's the underlying point. And most investors tend to not do this very well. They tend to either be invested fully in a asset class. Like currently, I'm seeing a lot of people are rushing towards equity. We saw times maybe 7-8 years back when people were rushing towards gold when gold was really doing well. I think the ideal case is to have a, a, a a set of investments in various different buckets. And hybrid funds allow you to do that in an auto way. Instead of you going out and trying to create your own hybrid category, which is not a bad thing. I mean, if you have the time and obviously the expertise, it's something that can be done. But if you can't do it, hybrid funds offer you that vehicle to do. And within hybrid, of course, you have a whole set of funds. So there are conservative hybrid funds which put more money into fixed income instruments. You have aggressive hybrid funds which put money more into equity instruments. You have multi-asset funds which put money into a mix of debt, equity, and gold. So it gives you exposure to 3 or 4 asset classes. So it's a fairly well developed category, Neeraj, and it is in some sense the go-to category for a new investor today. Somebody comes and says, "Hey, I've never invested in mutual funds. Should I be putting money?" It is at a slightly lower risk spectrum as compared to say a pure equity fund. So obviously his investment experience, the worry that most people have today is if I put money today and market falls, what happens? I lose principal. That tends to get in some sense not I won't say minimized, but tends to get slightly better if you are able to put money into a hybrid category. And it's a in fact the Indian mutual fund industry in some sense started with this type of a fund. Most people would have forgotten, but there was a scheme a very long time back called the US 64, which essentially was a hybrid, had a mix of debt, equity, and other investments. And that was at one point of time the first fund that many Indian investors, including people like our parents, would have possibly put money into. This is a very old fund now. So, and internationally, this is also a great asset class. So today, it's got a pretty sizable following. Uh, the mutual fund industry now is about 33 lakh odd crores of assets we manage, and almost about 11%, that is in excess of about 3 lakh crores, is now sitting in hybrid funds today. So it's a good category to look at, especially when market valuations are high, especially for first time investors, or in some sense for people like me who are lazy investors who don't have the, who don't have the bandwidth or the time to keep trying and moving assets around between equity and debt. And I think I am it's sort of like a, if I may use the word, a little bit of like a fill it, shut it, forget it kind of investment. And the more asset classes you put in, Neeraj, like a multi-asset, the better is the risk profile in that sense improves a little more.
Got it. Now, just before I get in, Kshitiz, I just want a quick follow up with you, and Raghav, and that is, I think 3 weeks back, and it's a few people won't be surprised why we're doing a show on such a similar topic so soon. But just 3 weeks back, I think Swarup Mohanty of Mire was here, and he was making a case for how aggressive hybrid seems to be a really good category compared to other forms of mutual fund investing, wherein it involves multi-asset. Now, my question is just that when you are making, I'm presuming that out here you're making a case for hybrid fund categories. Would you believe that there are enough options available, and would you believe that particular subsets within this hybrid category would be better suited for, say, first time investors or investors who don't have the time? I think you described that perfectly. Lazy or don't have the time, because that's what the show is aimed
Yeah,
for right now.
yeah.
People who don't have the time.
I, I, yeah, I think aggressive hybrid is an interesting case. Obviously, it's an interesting asset class. Obviously, it is meant for slightly higher risk investors. So somebody came and told me that I have maybe just a 2 3 year time frame. Should I put an aggressive hybrid? I might not say yes to that, because I think you need to give those investments time because they are predominantly equity investments. The other category, Neeraj, which doesn't get talked about too much, but I think is very interesting, is multi-asset funds, and those are nothing but equity, debt, plus a bit of gold. And I think you will, as and when we get more liquidity in other asset classes, you will see newer and newer asset classes coming there, and that's the beauty. And I mean that's if you look at it, this is the fund I was telling you about, triple asset. So if you look at it, just look at the way stocks, bonds, golds have done. So if you're an investor who started off in 2016, you would have made 4% return, and that's the concern that most people have today. That hey, markets are at 52,000. If I come in now and the market doesn't give me a return, what happens? Now look what happens to the second year. I mean, that was a year in 2017 where we didn't see too much equity come in. Equity markets did very well. But just look at the extreme right column. If you see largely your triple asset combination, and this is nothing but a very simple, basic, 65% equity, 25%, 20% debt, and 15% gold kind of a combination number that is being given to you. Just look at those returns. So those are also, pretty decent, and more importantly, they tend to mirror your equity returns, and in some cases do much better than them also. And if you see, there will be cases, and there is more data available, and when equity market falls, these funds tend to do much better because obviously they have a much lower allocation to equity as compared to a pure equity fund. So the other thing that you should think about is this category also here. This triple advantage funds, or what I call multi-asset funds. They are another category that investors should think about. Yes.
Yeah, especially at these times. We also just keep that
Yes.
in mind. I think a lot of this conversation is also timed around the current market structure too. Though nobody can time the market, but still, at times it helps to make a prudent decision. Let's get into Kshitiz in this discussion as well. Kshitiz, um, uh, uh, you heard what Raghav had to say. Okay, we'll just get Kshitiz in a moment. Let's just give it a minute. Maybe the video is just taking time to load, but Kshitiz should be with us any moment. Raghav, can I just ask a follow-up to you while we just wait for Kshitiz to come? Would the quantum of correlation, and then we'll get in Kshitiz in this, but would the quantum of correlation that these different asset classes have amongst themselves also make it obvious to do a hybrid or a balanced advantage or a multi-asset fund?
Yes, that's true. In fact, that's the beauty of asset allocation, that you need to sort of invest in asset classes which are reasonably divergent in the way they behave. So, in most of these three asset classes, we've done some work around equity, gold, and debt. Like I told you in triple advantage, they are pretty much divergent from each other. So when equity does very well, you will find that gold typically does not do well, and vice versa. You will find that when gold does very well, and that's the slide in front of you. If you see, there's the 8% is the amount of correlation that it has to equity. So if you see between gold and equity, there is absolutely no correlation. Between debt and equity, there's very, very little correlation. So if you have a combination of these three assets, may not be the perfect, it may not give you the best return. If people are really looking at, hey, I want to beat every other index under the sun. That's not the case. But yes, these strategies really work during periods of market fall, and more importantly, of market volatility, and more importantly, when markets are just about flat and doing really nothing. That's the time that these strategies really do well.
Okay. Kshitiz, can you hear me?
Yeah, I can hear you. Can you hear me?
Loud and clear, Kshitiz. So, Kshitiz, please tell me, I think we're losing you a bit, but let's just try if this works. You probably heard a lot of conversation that Raghav had to do. Now, do you differ with Raghav? And it's good to differ, by the way. Do you have a view on what's the optimum way to approach markets if somebody wants some bit of diversification in not a purely equity fund?
So, Niraj, first of all, Raghav, thank you for your dope on what is going on as far as the balanced category funds are there. So my take is almost on the same line that yes, somebody who wants to participate at these level, hybrid equity funds are the right way of looking at it. The only place where I differ from Raghav is that I look at that balanced advantage fund will be a better bet now. The reason is, one is they are more tax efficient vis-a-vis multi-asset fund. Second, right now, the biggest fear is that if things will look better in US and you will have unwinding of money which is coming in India will start, that can lead to a market fall. So, when things will be looking better in US, I think the gold will also tend to not do that well, because gold prices are not decided by what is happening in India. It's a global commodity. So, multi-asset funds are a great fund to be a part of the portfolio. But I will like to say that I'll go with balanced advantage fund, wherein client, as rightly said by Raghav, like balance things at his or her end, but can leave to a fund manager depending on the market condition, what type of equity or debt allocation can be there. So there are different type of balanced advantage funds which are available, which works on various parameters. Like few of them works on price to book value, which is like ICICI backed. Three of them works on price to earning, and then you have Motilal and Edelweiss, which works on a different model. Like Motilal has their own movie index, and your Edelweiss balanced advantage fund, it works on volatility as well as your trends, your short term as well as long term trend. So balanced advantage fund, what it does, it depending on the approvals of various AMCs, normally it keeps equity ratio between 30 to 80%. So as on date, if you see most of the balanced advantage fund, they have a equity allocation between 39 to 40%. If you take exception for two balanced advantage fund, excuse me, one is HDFC Balanced Advantage Fund, which is run like a balanced fund only. So I must say that it's no more a balanced advantage fund. It has 65-70% on an average equity allocation. Second is your Edelweiss Balanced Advantage Fund, which has an equity allocation of 68%. But it's a daily balancing balanced advantage fund. It balances equity and debt very fast. So I think it gives a lot of comfort to people. Let's say somebody parking in 100 rupees today and picks up a couple of balanced advantage fund. They can have as on day 35-40% equity and balance in arbitrage and debt. As and when markets gives opportunity, depending on the fall which is coming in the market, it keeps on increasing the equity allocation. So that's how balance advantage funds work. And I know if you actually see one in last 1 3 or in last 1 month, 3 month to 6 months, they are underperforming equity big time because yes, markets are heated up and equity allocation is less. But at these level, I will say that one can look at BAF as the option.
Okay, Kshitiz, just one quick follow-up. What is the advantage that a BAF would have over an equity hybrid fund? You mentioned tax advantages amongst other things. Can you just very briefly enumerate that?
So the first is that asset allocation fund will have a fixed income taxation, which is long-term taxation after 3 years with 20% cap, 20% with cap your indexation benefit. That's the taxation on the your multi-asset or asset allocation fund. On BAF, it is treated like a equity mutual fund or as an equity asset. So you have a long-term capital gain as 10% over and above 1 year. Number one is this. Second is when it comes to asset allocation, where you do asset allocation between equity and fixed income, let's say 60, 40, 30, 70, whatever percentage, you don't have to do it yourself, as put by Raghav, that if you are a lazy investor and you don't want to come out of equity allocation, then balance fund at these times are the right approach, wherein balance advantage fund are the right approach, wherein you don't have to do it yourself. Fund manager will do on your behalf, depending on market conditions.
Correct. Raghav, just one quick word. Now, of course, you believe that, and I'm not saying that you might believe that BAF is also not a good category. Maybe BAF is a great category, as it is enumerated too. But since your belief is that hybrid funds are a great fund, is there a product or is there a set of products within the access table that you guys have as well in this category? And would you recommend or would you believe that they might be better suited than a pure play equity fund from the access table as well? I know I'm asking a bigger question, but that's what I'm going to do.
That's a tough one. See, I think all access funds are we have an underlying theme under our schemes, which is essentially focus on quality. That obviously continues into the hybrid space as well. What we do have in the access table is, of course, dynamic equity, which is the BAF category. We have conservative hybrid. We have the aggressive hybrid, which is, and of course, we have another interesting fund called the equity saver, which is comes into the. So we have essentially all the four categories which are available under these particular categories. Now, if it's exactly Neeraj, what I said. So if I had the time and the expertise to sort of move money around, and I'm comfortable at to do that on my own, I'm very happy to put money into equity. What we have also done at Axis is introduce an element of international equity into some of our portfolios, and these are largely uh, into themes like ESG, things like global innovation, where the stocks or those opportunities may not be available in the listed space in India. So that's another way of diversifying in some sense, your assets, because the more, as I said, the more asset classes you put in, and if they have low degrees of correlation, that obviously leads to a better investment outcome. So that's one way of doing it. The other way, of course, is to do it the way investors like me do, which is just like a fill it, shut it, forget it. Where again we have done very very well on falls. So we have a similar model approach like Kshitiz was approaching. We have a model that looks at price, we have a model that looks at volatility, and we have a model that looks at trend. And all these three are put together. And so in last year, we did very well when the markets fell. Obviously, in the catch up, these funds are essentially meant to help you during market falls, and they are largely seen to be very very lower risk instruments in that sense. So yes, again, I would just put it that it's again based on the investor risk profile. If the investor has the ability to look at assets on his own, if he's got competent advice or he's well read, I think obviously he can create his own asset allocation diversification by investing into a basket of equity and basket of fixed income. If he feels that no, I'd rather assert it to a fund management, I think Axis has all the other four options which are available for him, depending on what he wants to do. And of course, the time horizon of him. These are the two things: the risk tolerance as well as the time. I think that should be the influencing factors in deciding which scheme to put it in the hybrid stable at.
Got it. Thanks for that, Raghav. Now, Raghav, I'll just urge you to stay on because just want your opinion on one of the topic that me and Kshitiz has decided we'll speak about. Kshitiz, before we get to that, very quickly in under a minute, can you talk about the funds in the BAF category that you would recommend? I think you gave out the list, but why is it that one fund is making the list of yours? Which is your favorite BAF recommendation currently?
So I don't have any one single fund as favorite, but there are 3-4 good options which are available. You can actually, as I said, that one is your Kotak Balance Advantage Fund, which is one of the good funds one should look at. It works on the principle of price.
Sorry, Kshitiz. I think this is the mid-cap fund recommendation list that we have. So not this one, but there is another one that we have. Maybe if we have, it's great. Otherwise, but this is the second plate that we want to show. Let's just first talk about the balanced advantage category, right? So which is it that you're recommending, Raghav? Sorry, Kshitiz, sorry.
Okay, so I'm saying one is your Edelweiss. First is Kotak Balanced Advantage Fund. Now, one need to understand that people who are watching this show that these funds balance between equity and debt on certain parameter. So this fund, Kotak balances on the fund on the basis of price to earning. That what is the price of a stock divided by what is the earning per share, earning per stock. So, which is one of the parameters which this fund uses, and it does on a monthly basis. That's what it does. Then second is your Edelweiss BAF, Balanced Advantage Fund, which I spoke about. It works on the function of your, trend ratio, which is short-term and long-term trend, and your volatility ratio. So they can move between 30 to 80%, and they are given 17% to each and every ratio. Short-term trend, and they are also, as rightly said by Raghav, in Axis Fund, they are also able to maneuver the last fall, which will happen in the first wave of COVID, because the trend was showing that they should move out, and they have moved out of equity fast and reduce the equity allocation. Third fund, which is a evergreen fund, which is from Raghav's ex company, ICICI Balanced Advantage Fund. Already to ICICI BAF, they have actually set the tone right for the industry to look at BAF as a category. It's a very old fund, and it works on the function of price to book value. So book value is the total assets, which is total assets minus liabilities. So that's come out to be a net asset what company has. So that it works on price to book value model, and it average the portfolio on a daily basis. Fourth fund, which somebody want to add, like I'll say, once you look at a couple of funds, not more than that, somebody want to really add, then they can look at Motilal Oswal Dynamic Fund. And this is very interesting. It works on an in-house index, which is called MOVI, Motilal Oswal Valuation Index. So they work on the parameters of price to earning, price to book value, and dividend yield. All three parameters they work on, and they have divided all the parameters in 1/3 proportion each. So depending on that, they divide between equity allocation and fixed income allocation. So for the benefit of everyone, because all these funds qualify as equity mutual fund, and they have an equity taxation benefit. If the equity allocation you see at 37-38%, balance has been done by 65% is done by arbitrage, which qualify as an equity category. So as a fund at fund level, it is subjected to equity taxation only. But yes, your pure equity exposure is not more than 38-39% across these funds. Edelweiss, yes, right now they have 67% allocation, because as per their trend, it's not showing that right now they should go further decrease in equity allocation. But all funds have been consistent in their yearly returns as well as their 5-year track also.
Sorry, Niraj.
Some of you might be, I was on mute. Sorry, I put myself on mute so that the voice doesn't filter through. But okay, here's the last point on this conversation. And some of you might be wondering that while all of this is great, but I'm a risk taker. I'm happy to invest for 10 years, and therefore I'm happy to put in a pure play equity fund. So what is the best category within equities, pure play equity funds to invest into? Now here, Kshitiz, I want to start off with you. You are mentioning that you believe that mid-cap funds might be a good category to invest in currently. Why?
So if you actually ask me, somebody who's looking at to invest at these levels, let's say you want to participate tomorrow morning in the market, the best way is to stagger the investment, irrespective of whether you're a new investor, you're an existing investor, or you're an aggressive investor. Once you look at least 4 months, a weekly STP in mutual fund, stocks, or whatever investment vehicle you're participating through, whether it is PMS, because we are at a high valuation. I see that mid-cap funds, which normally people see, it's a mid-cap company. But just for the information and clarification of all these mid-cap companies are actually next Nifty 50, or maybe companies which are at 30-35,000 crore market cap. So they are actually at a discount to large cap and small cap by 25 to 30% as on date. So this is really interesting. So SEBI in 2018 has defined the category. They said 101st company by market cap in India to up to 250th company is a mid cap basket, and one need to have 65% portfolio at least in mid cap basket to have to qualify as a mid cap fund. Now these funds on an average has a market cap of in excess of 30,000 crore. So they are actually you can say the largest side of the mid cap fund. So one can look at mid cap basket to invest in, and the right way to invest is if you have 100 rupees, start participating 6 rupees every week for next 16 to 17 weeks. That's the right way to participate. One can make out from the chart. This chart has been sourced by Sundaram Mutual Fund that mid cap index is at a discount to large cap and small cap. So I will go with mid cap allocation right now. People who are already investing into it. For a new investor, obviously the balanced fund category fund is the right way to look at it.
Raghav, do you have any thoughts here?
No, it's every man to his risk profile. I agree with Kshitiz. I think I have a fair amount of money in Axis Midcap Fund, and I have built that exactly like the way Kshitiz has done. I've been putting money every month, irrespective of where the index is, where the market is. It just goes automatically up. So that comes back to my first point, Niraj. I think the time in the market is much more important than timing the market. So yeah, that's where I am.
Okay. Kshitiz, you want to wrap with the name of the funds that you believe in the mid-cap category, which could be invested in?
So, obviously, I was not knowing Raghav is coming on the show. I'm being honest, you never told me. Axis Midcap is one of my favorite fund, and it's been consistent. As I said that, I will not look at a 1 year performance for a fund. I will look at a consistent rolling, performance year on year performance, and they've been very consistent in their approach. So one should look at one Axis Midcap fund. DSP Midcap again, very good funds. Vineet Samre has done a fantastic job while managing the DSP fund. Kotak Emerging Equity Fund again very consistent and very good in terms of its performance. HDFC Midcap, and then we have PGI Midcap, which used to be initially Religare, then the company became Pramerica, and now it's PGIM, and BNP Midcap Fund. So all these 6 midcap funds have been doing really well. I would like to say here, Niraj, my last submission here is that people who are talking about that markets have gone up, they should look at their equity and debt allocation right now. If they are very high on equity allocation, let's say they have decided on 60-40 and they are right now at 75-25, then they should trim it a bit on the equity side, and they can park it in the balanced advantage fund. Those who are at let's say 5-7% only above from their equity allocation, they can just keep on holding the allocation, and for the future allocation or further allocation, they can stagger it over next 3 to 4 months time. Now, my liking or my I like midcap as a basket. They can look at what type of portfolio depending on their risk profile they want to go with. Third, people who are underweight in equity, still please don't go all out and buy an equity mutual fund. Please look at staggering it again over next 3 to 4 months. That's the right strategy to build your portfolio.
Kshitiz, thanks so much for joining in today and giving us your thoughts. And Raghav, it was lovely having you. Thank you for being with us today.
Thank you,
Look forward to having you more often.
Thank you, Niraj.
Thank you, Niraj. Thanks, Kshitiz.
Thank you, sir. Thank you.
Stay safe.
Viewers, thanks for tuning into this leg of the Mutual Fund Show.